China didn't come to the negotiating table just to make friends. They have a clear set of objectives and they're playing the long game. This isn't just about a few trade deals or economic partnerships. It's about positioning themselves as a dominant global power. Their strategy involves leveraging their economic might to gain political and technological advantages on the world stage. They want things, specific things, and they're willing to negotiate hard to get them. These aren't just minor concessions. They are key elements that will shape the future of their economy and global influence. First off, they want access to our massive consumer market. The American consumer is a goldmine for any country looking to expand its economic influence. With over 300 million potential customers, the U.S. market represents a significant opportunity for Chinese businesses to grow and thrive. They want their electric cars zipping around American streets, their tech giants dominating our app stores. Imagine a future where Chinese brands are as ubiquitous in the U.S. as any homegrown company. This would not only boost their economic footprint, but also enhance their soft power and cultural influence. Think of it like that friend who always wants to borrow your clothes, but on a much grander scale. It's not just about sharing, it's about influence and presence. By embedding themselves in the daily lives of American consumers, they aim to create a lasting impact that goes beyond mere economic transactions. Second, they want those pesky tech sanctions gone. These restrictions have been a thorn in their side, limiting their technological advancements and global competitiveness. Removing these barriers would allow them to accelerate their innovation and catch up with or even surpass Western tech giants. They're tired of being treated like the kid who sits alone at lunch. They want to be part of the tech elite, rubbing shoulders with the best in Silicon Valley. Inclusion in this exclusive club would not only validate their technological prowess, but also open up new avenues for collaboration and growth. They want to buy our high-end chips, the ones that power everything from smartphones to, well, probably some stuff we don't even know about yet. These chips are the backbone of modern technology, and China wants in. Access to these advanced semiconductors would significantly enhance their technological capabilities and global competitiveness. And finally, they crave stability. Economic stability is crucial for maintaining their growth and ensuring their place on the world stage. A stable economy allows them to plan long-term strategies and invest in critical sectors without the fear of sudden disruptions. Their economy has been hit by a nasty cocktail of lockdowns and global uncertainty. The pandemic has shown just how vulnerable even the most robust economies can be. Ensuring economic stability would help them mitigate these risks and maintain their growth trajectory. They need this trade deal to go through like a teenager needs Wi-Fi. It's not just a want, it's a necessity for their future growth and stability. Without it, they risk falling behind in the global race. This deal is a critical component of their broader strategy to secure their economic future and solidify their position as a global leader. Now, America isn't exactly negotiating from a position of weakness. With a robust economy, a powerful military, and significant influence on the global stage, the United States has a lot of leverage in these discussions. Our priorities are clear, and we're ready to assert them. The U.S. economy is one of the largest and most dynamic in the world, driven by innovation and a diverse range of industries. Our military capabilities are unmatched, providing a strong deterrent against any potential threats. Additionally, our diplomatic influence allows us to build coalitions and partnerships that further our strategic interests. We've got our own list of demands. These aren't just minor requests. They're critical issues that we believe need to be addressed to ensure a fair and balanced relationship. Our demands cover a wide range of areas, from trade imbalances to intellectual property rights, and from cybersecurity to national security. Each of these issues has significant implications for our economy and our national well-being. Think of it as our grocery list for this trade deal, except instead of milk and cookies, it's national security and economic dominance. These are the essentials that we believe will safeguard our interests and promote our values. Just as a grocery list ensures we get everything we need for our household, our list of demands ensures that we address all the critical areas that impact our nation's future. First and foremost, we're talking national security. This is non-negotiable. We need to ensure that our nation is protected from any potential threats, both physical and digital. Our national security strategy encompasses a wide range of measures, from strengthening our military capabilities to enhancing our cybersecurity infrastructure. We must be prepared to defend against any form of aggression, whether it comes from traditional military forces or cyber attacks. We're worried about their tech being used for spying or, God forbid, some kind of cyber warfare. The stakes are incredibly high, and we can't afford to take any chances. The potential for espionage and cyber attacks is a serious concern, as these activities can compromise our national security and undermine our economic stability. We need to implement robust measures to protect our critical infrastructure and sensitive information. It's like letting a stranger borrow your phone, but that stranger might be reading your texts and selling your data on the dark web. The potential for misuse is enormous, and we need to be vigilant. Cybersecurity is not just about protecting our data. It's about safeguarding our privacy and maintaining the integrity of our digital systems. We must stay ahead of emerging threats and continuously improve our defenses. Second, we want to tackle that pesky trade deficit. This imbalance has been a thorn in our side for years, and it's time to address it head-on. The trade deficit represents a significant economic challenge, as it indicates that we are importing more than we are exporting. This imbalance can lead to job losses and weaken our economic position. By addressing the trade deficit, we aim to create a more equitable and sustainable trade relationship. We've been buying more of their stuff than they've been buying of ours, and it's starting to feel like they're winning at economic monopoly. This isn't just about numbers, it's about fairness and reciprocity in trade. A balanced trade relationship ensures that both parties benefit and that economic growth is shared. We need to create opportunities for American businesses to compete on a level playing field. We want them to buy more American goods, from soybeans to Teslas. Our farmers and manufacturers deserve a fair shot in the global market. By increasing exports of American products, we can support our domestic industries and create jobs. This is not just about economic growth. It's about supporting our communities and ensuring that our businesses thrive. Third, we're cracking down on intellectual property theft. This is a serious issue that undermines our innovation and creativity. Intellectual property theft not only harms our businesses, but also stifles innovation and creativity. By protecting our intellectual property, we can ensure that our inventors and creators are rewarded for their hard work and that our economy remains competitive. We're accusing them of ripping off our ideas, copying our tech, basically stealing our homework, and then trying to sell it back to us. This kind of behavior is unacceptable and needs to be stopped. Protecting intellectual property is essential for fostering innovation and maintaining our competitive edge. We need to enforce strict measures to prevent theft and ensure that our businesses can operate in a fair and secure environment. And finally, we're looking to diversify our supply chains. Relying too heavily on one country for our manufacturing needs is risky and unsustainable. Diversifying our supply chains can reduce our vulnerability to disruptions and create a more resilient economy. By sourcing materials and products from multiple countries, we can ensure that our supply chains remain stable and that our businesses can continue to operate smoothly. We've become a little too reliant on them for manufacturing, and it's time to spread the love, economically speaking. By diversifying our supply chains, we can reduce risk and create a more resilient economy. This is about building a stronger, more secure future for America. A diversified supply chain not only enhances our economic security, but also promotes global trade and cooperation. By working with a variety of partners, we can build a more inclusive and sustainable global economy. Okay, so who comes out on top in this deal? Is it the United States, with its vast consumer market, or China, with its manufacturing prowess? It's complicated, like trying to figure out who got the better end of a deal on Pawn Stars. Both sides have their own set of advantages and challenges. In the short term, China might just be the winner. Their economy gets a much-needed boost and they gain access to American markets. They get that much-needed economic boost, access to our markets, and the opportunity to sell more of their products to American consumers. Plus, they get a break from those pesky tech sanctions that have been holding back their technological advancements. It's like finding a $20 bill in your old jeans, a welcome surprise that can make a big difference. But in the long run, that's where it gets interesting. The dynamics of global trade could shift significantly. That's where it gets interesting. If China can maintain its growth and innovation, it could become an even more formidable economic power. If China plays by the rules, adheres to international trade agreements, buys more of our stuff, and opens up its markets to American products and stops with the alleged IP theft, the landscape of global trade could change dramatically. America could come out ahead, benefiting from increased exports and a more balanced trade relationship. Of course, this all hinges on whether China actually sticks to the deal. Trust and verification will be key. It's like trusting your roommate to do the dishes. You hope for the best, but you've got that nagging feeling they might just forget. The stakes are high and the outcome is uncertain. Uncertainty in key sectors. The ongoing trade talks between the USA and China have left many industries in a state of flux, with both opportunities and challenges on the horizon. Some parts of this deal are murkier than a glass of Mississippi River water. Take the auto industry, for example, where the stakes are incredibly high for both nations. China wants to flood our streets with their electric cars, aiming to dominate the global market with their advanced technology and competitive pricing. But American automakers are crying foul, saying it's not a level playing field. They argue that Chinese subsidies and lower labor costs give their competitors an unfair advantage. They're worried about Chinese companies undercutting them on price and flooding the market, which could lead to significant job losses and factory closures in the US. And then there's the whole chip situation. Semiconductors are the backbone of modern technology, and both countries are vying for dominance in this critical sector. We want to sell them our high-tech chips, which are essential for everything from smartphones to military equipment, but we also don't want to give away our technological edge. The fear is that China could reverse engineer these chips and surpass us in innovation. It's like trying to teach your dog to play poker. You want them to learn, but not well enough to take all your money. The balance of cooperation and competition is delicate. These are just two examples of the many hurdles this deal still faces. From intellectual property rights to market access, the road ahead is fraught with challenges. It's a delicate dance, folks, with negotiators on both sides trying to find common ground without giving too much away. And one wrong step could send everyone tumbling. The stakes are high, and the outcome of these talks will shape the future of global trade. Beyond Trump, the future of the deal. As we look ahead, the landscape of US-China trade relations is uncertain. Let's be real, this whole trade war thing was kind of Trump's baby. He initiated the tariffs and pushed for a tougher stance on China. He loved a good tariff more than he loved tweeting at 3 a.m. His administration believed that tariffs would protect American jobs and industries. But now that he's not in the Oval Office, who knows what happens? The new administration might have a completely different approach. Will the next president be as gung-ho about confronting China? Or will they prioritize rebuilding alliances and focusing on other global issues? Or will they try a more diplomatic approach, perhaps seeking to resolve differences through negotiation and cooperation? It's like trying to predict the weather in Vegas. Could be sunny, could be a dust storm, could be a swarm of locusts. Only time will tell. The future of the deal remains as unpredictable as ever. A new world order? The global power play. As the world watches, the stakes have never been higher. This isn't just about trade, folks. It's about strategic alliances, economic policies, and the future of international relations. It's about who gets to call the shots in the 21st century. The decisions made today will shape the geopolitical landscape for decades to come. It's about global leadership, economic dominance, and the future of, well, everything. From technology to finance, the ripple effects will be felt worldwide. China wants to be the top dog, the big cheese, the one calling the shots. Their ambitions are clear and their strategies are meticulously planned, and they're not afraid to throw their weight around to get there. With a growing military and booming economy, they're making bold moves on the global stage. America, on the other hand, is used to being the reigning champ. For decades, the US has set the rules and led the way in global affairs. We wrote the rule book, and we're not too keen on someone else rewriting it. The principles of democracy and free trade have been our guiding lights. This trade deal is just one battle in a much larger war, a war for global supremacy. Every negotiation, every tariff, is a move in this high-stakes game, and it's a war with no clear winner in sight. The outcome remains uncertain, and the world watches with bated breath. The clock is ticking 90 days to decide the future. This period is crucial for both nations as they navigate through complex negotiations and economic strategies. Remember that 90-day truce I mentioned earlier? It was a temporary halt to escalating tariffs, giving both sides a chance to come to the table and discuss their differences. Yeah, that's the time these two economic titans have to figure out if they can actually play nice. High-stakes meetings and intense negotiations are underway to resolve key issues. It's a race against the clock, folks. The financial markets are watching closely, and any misstep could lead to significant economic repercussions. Can they iron out the details, build some trust, and avoid another trade war? The stakes are high, and the world is watching to see if a sustainable agreement can be reached. Or will they revert to their old ways, slapping tariffs on everything from chopsticks to cowboy hats? The consequences of failure could be severe, impacting global trade and economies. This is one reality show you don't want to miss. The outcome of these talks could shape the future of international trade for years to come. Gap 1S, the devil in the details. Points of contention. In any negotiation, the smallest details can become the biggest hurdles. As we inch closer to the deadline, it's crucial to understand what might derail this high-stakes negotiation. The stakes are incredibly high and both sides are feeling the pressure. On the American side, intellectual property theft and forced technology transfers are major sticking points. These issues have long been a source of tension between the two nations. The U.S. wants ironclad guarantees that China will stop these practices. They are pushing for strict enforcement mechanisms to ensure compliance. Meanwhile, China has its own red lines. They are equally firm in their stance and have their own set of demands. They're wary of opening up their markets too much and losing control over their economic policies. This fear of losing economic sovereignty is a significant concern for China. Issues like state subsidies to Chinese companies and market access are potential deal breakers. These subsidies are seen as vital for China's economic strategy. Both sides have deeply entrenched positions, and neither is willing to compromise easily. This makes finding common ground extremely challenging. This tug of war over key issues could very well determine the fate of the deal. So, what will give? The outcome remains uncertain, and the world is watching closely. Stay tuned as we delve deeper into these critical points of contention. The resolution of these issues will shape the future of global trade relations. Gap 1S, the currency conundrum, the future of global trade. As the world watches closely, the decisions made in these negotiations could redefine the landscape of international finance. One of the most pressing questions that looms over these negotiations is whether China will continue its efforts to de-dollarize or if it will maintain its use of the US dollar. This decision is not just about currency, but about the broader implications for global economic power. On one hand, moving away from the dollar could give China more financial independence and reduce its exposure to US economic policies. This shift could also signal a move towards a more self-reliant economic strategy. This could be a step towards asserting its own currency, the yuan, as a dominant global force. Such a move would not only elevate China's economic status, but also challenge the existing financial order. However, the transition would be fraught with challenges. The complexities of shifting away from the dollar involve significant risks, including potential market volatility and economic instability. The US dollar is deeply entrenched in global trade, and shifting away from it could create significant short-term instability. The ripple effects of such a change could be felt across global markets, affecting trade, investment, and economic growth. On the other hand, sticking with the dollar maintains the status quo, ensuring smoother international transactions and less immediate risk. This approach provides a sense of stability and predictability in global trade. But this also means continued reliance on a currency controlled by a geopolitical rival, which could be seen as a strategic vulnerability. The dependence on the dollar exposes China to the influence of US economic policies and decisions. The implications of either decision are profound. Each path carries its own set of opportunities and challenges, shaping the future of global economic relations. A successful de-dollarization could reshape global finance, reducing America's financial leverage and potentially leading to a more multipolar world order. This shift could democratize economic power, allowing for a more balanced global financial system. Conversely, maintaining the dollar's dominance could reinforce existing power structures, but at the cost of perpetuating the current imbalances. The status quo may benefit some, but it also sustains economic disparities and dependencies. As the clock ticks down, both nations are weighing the potential fallout of these choices. The urgency of the situation adds pressure to make a decision that will have long-lasting impacts. The outcome will not only affect the terms of the trade deal, but could also set the stage for the future of international economic relations. The stakes are high, and the world is watching to see which direction these economic giants will take. Stay with us as we unravel this complex web of economic strategies and geopolitical maneuvers. The decisions made here will echo through the corridors of global power for years to come. As the trade negotiations intensify, another pivotal question arises. Will China continue to buy U.S. bonds, or will it cease its purchases? This decision is not just a matter of financial strategy, but also a significant geopolitical maneuver. This decision carries significant weight for both nations and the global financial market. The ramifications could extend far beyond the immediate economic impacts, influencing global trade policies and international relations. On one hand, continuing to buy U.S. bonds provides China with a stable investment. This stability is crucial for a country managing vast amounts of foreign reserves and seeking to ensure steady returns, and helps maintain the value of its vast foreign exchange reserves. These reserves are essential for China to manage its currency value and support its economic policies. It also supports the U.S. economy by financing its debt, which is a critical factor in maintaining economic stability and growth in the United States, which in turn keeps American consumers purchasing Chinese goods. This consumer demand is a vital component of China's export-driven economy. However, there's a strategic angle to consider. The decision to buy or not buy U.S. bonds is also a tool of economic diplomacy and leverage. By holding a substantial amount of U.S. debt, China wields considerable influence over the American economy. This influence can be used as a bargaining chip in trade negotiations and other diplomatic discussions. If China were to stop buying or start selling these bonds, it could lead to a significant shift in the financial markets. It could trigger a rise in U.S. interest rates, making borrowing more expensive for businesses and consumers alike, making borrowing more expensive and potentially slowing down the U.S. economy. This slowdown could have a ripple effect, impacting global economic growth. On the other hand, ceasing bond purchases could also backfire on China. The interconnected nature of global finance means that such a move could have unintended consequences. The devaluation of U.S. bonds would reduce the value of China's existing holdings, leading to significant financial losses. This loss could undermine China's financial stability, leading to significant financial losses. These losses could affect investor confidence and lead to broader economic challenges within China. Additionally, the ripple effects on the global financial market could introduce instability, potentially triggering a financial crisis that affects multiple economies, which would not be beneficial for anyone. The interconnectedness of global markets means that instability in one region can quickly spread to others. The implications of this decision are profound. It is not just about financial returns, but also about maintaining economic and political stability. Continuing to buy U.S. bonds would maintain the current economic interdependence, ensuring a stable flow of capital between the two largest economies in the world, but at the cost of reinforcing China's reliance on the U.S. financial system. This reliance could limit China's ability to pursue independent economic policies. Stopping the purchases, however, could signal a shift towards financial independence. This shift could be part of a broader strategy to reduce reliance on foreign assets. But with the risk of economic turbulence, such a move could lead to short-term instability as markets adjust to the new reality. As these nations weigh their options, the world watches closely. The outcome of this decision will be a key indicator of future economic policies and international relations. The outcome will not only influence the terms of the trade deal, but also shape the future dynamics of global finance. The stakes are high, and the decisions made now will have long-lasting impacts, but also shape the future dynamics of global finance. The interconnected nature of today's world means that these decisions will reverberate across continents. Stay tuned as we delve deeper into this critical aspect of the negotiations. The next steps in these talks will be crucial in determining the future economic landscape. Beyond the bottom line, a battle for supremacy. This is not just a simple trade dispute. It's a clash of ideologies and ambitions that will shape the future of global economics and politics. At the end of the day, this isn't just about money. It's about power. It's about influence. The stakes are incredibly high, with both nations vying to set the rules of international trade and governance. It's about shaping the world in your image. Each country wants to project its values and systems onto the global stage, creating a world order that aligns with its own interests and philosophies. China and America, two giants with vastly different visions for the future, are locked in a struggle for global dominance. This rivalry extends beyond economics, touching on technology, military power, and cultural influence. And this trade deal, as complex and contentious as it is just one chapter in this ongoing saga. So buckle up, folks. The outcome of these negotiations could redefine international relations for decades to come. It's going to be a bumpy ride. The road ahead is fraught with uncertainty, and the stakes couldn't be higher for both nations and the world at large. Gap 1S. Now let's dive into another critical aspect of these negotiations: the USA's stance on China selling BYD cars and Huawei equipment in the American market. This issue has become a significant point of contention, reflecting deeper concerns over technology, security, and economic competition. On one hand, allowing BYD cars and Huawei equipment into the USA could bring several benefits. For American consumers, it means more choices and potentially lower prices, thanks to the competitive nature of Chinese products. For businesses, especially in sectors like telecommunications and automotive, it opens doors to advanced technology and innovations that could drive growth and efficiency. However, the drawbacks are equally compelling. National security is a primary concern, particularly with Huawei. The US government has long been wary of potential espionage risks and the implications of having Chinese technology deeply embedded in critical infrastructure. There's also the issue of economic sovereignty, as allowing a flood of Chinese products could undermine American manufacturers, leading to job losses and weakened domestic industries. So, will this be part of the trade deal? Analyzing the current climate, it's clear that both nations have strong incentives to negotiate carefully. For China, gaining access to the American market for BYD and Huawei would be a significant win, bolstering their global reach and economic influence. For the USA, any agreement would likely come with stringent conditions to mitigate security risks and protect domestic interests. Predicting the likelihood of this being accepted or rejected in the negotiations is tricky. While there is room for compromise, it will require both sides to make significant concessions. The USA might agree to limited conditional access, perhaps involving strict regulations and oversight. Conversely, China could offer reciprocal benefits, such as easing restrictions on American companies operating in China or addressing other trade imbalances. In conclusion, the inclusion of BYD cars and Huawei equipment in the trade deal is a complex and contentious issue, emblematic of the broader challenges in US-China relations. As negotiations continue, both countries will have to weigh the potential benefits against the risks, aiming for a solution that advances their respective interests while maintaining a delicate balance of power. The outcome remains uncertain, but one thing is clear: the stakes are incredibly high for both nations and the future of global trade.